Well, it's shaping up to be yet another difficult month across stock indices globally. However, we're seeing a little bit of a bounce first thing this morning. Want to know more? Keep watching. Hello, I'm David and this is Trading Today. Yes, we had another dismal session on Friday across Wall Street. The Dow ended down 1.1%, the S&P was down 0.5%, the NASDAQ up 0.4%. Now today we are seeing a little bit of a bounce back, and the levels I'm looking at in the S&P really, we're around the 41-45 level. I think this 4100 is going to be a very significant area of support, whereas the index and the upper, it's quite straightforward. Anything above 4200 means there's still some life in the old dog yet, and that seems to be how things are playing out, and we're smack in the middle of those two levels as we speak. Now, bond yields once again are a major concern. We still have the yield on the key 10-year Treasury note trading around 4.9%, not a million miles away from that 5% level where we saw a big pullback in yields, a big increase, a big rally in bonds, but not dramatic enough to take us away from this 5% danger zone, so keep an eye on that. Now, it's a very big week for a number of reasons. First of all, we've got some central banks meeting. First off, we start with the Bank of Japan overnight tonight. They're not expected to change their interest rates. However, they are expected to push their fiddle about with their yield curve control, which effectively is tightening rates, which hopefully, as far as the Bank of Japan is concerned, will see the yen strengthen and the dollar yen pull back from this 105 mark, I beg your pardon, 150 mark, which has been so problematic in the past, and we'll see what happens overnight. We also have the Federal Reserve. They are meeting on Tuesday and Wednesday with an announcement on Wednesday evening, and the Bank of England on Thursday. We've also got Apple earnings out on Thursday. After that is only Nvidia of the Magnificent Seven to go. So very important thing at the moment. We are, as far as investors are concerned, there's the two pools of thought on high bond yields. The first is that from Treasury Secretary and old Federal Reserve Chair Janet Yellen. She says that these high yields are an indication of the strength in the US economy, and she's pointing to the Q3 GDP report which came out last week, where it showed that sort of for the quarter, the year-on-year figure plus 4.9% GDP, an incredibly strong figure, as strongest for 2 years as we were coming out of the post-pandemic that crash, the pandemic crash, and we saw this sort of galloping ahead of GDP in the aftermath of that, and of course the beginning of all our inflationary troubles. So that's one side of the story. The other side of the story is that investors don't want to buy US Treasuries because there's a deluge of supply coming out. The Federal Reserve isn't there buying Treasuries anymore. In fact, it's selling them. And there's this huge US debt problem over which policymakers have either no willingness to do anything about, or they completely lack the wherewithal to do anything about it. And so this is really all a bit disastrous. As far as the Federal Reserve is concerned, of course, you've got stronger GDP growth, there's a strong US economy, you've got a tight labour market, and these are two reasons, and of course inflation is still well above target. There's three good reasons why you should continue on raising rates, and yet as far as the CME FedWatch tool is concerned, there's pretty much zero chance of them raising rates on Wednesday, and there's only a 20% chance of them raising rates at the December meeting. I hope you found this of interest. If you did, please like and follow, and best of luck with your trading. Goodbye.